You know exactly what fair value gaps are: displacement, manipulation, accumulation, and all these different PD arrays, and you're still unprofitable, then this video is for you. This is how Landon went from blowing 3 funded accounts to getting his first $29,000 in payouts in 2 weeks, and how Jonathan made over $19,000 in his first 2 months. By the end of this video, you're going to be able to spot the difference between B setups and A plus setups that you're going to use to pass funded accounts and get payouts. And the same exact mental checklist that I go through to trade my IPD FEG model to get thousands of dollars in payouts every single month. And just for proof, you can see I made over $3,000 just today trading an A plus setup with my IPD FEG model, $424 times 5 top step accounts, and also a $1,248 trade on GOAT funded futures. And first, you need to understand exactly why it's important to take A plus setups and knowing exactly when to take an A plus setup versus a B setup. Right here, this is going to be exactly how to rinse prop firms, a quick overview on how to rinse prop firms and why it's actually important to take A plus setups. As we can see right here, pass rate of a prop firm depends on 3 factors: your win rate, your risk to reward, and your position sizing. According to 2024 Top Step Trader statistics, you can see only 12.4% actually pass a funded account. Out of 100,000 traders, only 12,400 actually pass. And only 3,500 of those 100,000 traders actually get a payout. And that's why it's super important to be able to determine the difference between an A plus and a B setup. Now, why is it actually important to get A and B setups? It's important to get A and B setups because with this trading model, the IPD FEG trading model, it is a low variance trading model, meaning you have a higher percentage win rate and a lower risk to reward, which means your losing streaks are short and rare, your drawdown periods are shallow, and prop firm risk stays inside the drawdown limit, and you will get paid out. Now, what does this mean in terms of prop firms? Well, when you find prop firms with no consistency rule in funding and a 50% consistency rule during your actual evaluation, this is super important because what you need to understand about how to actually get max payouts with prop firms is during your evals, you have a 50% consistency, which means you are risking $500 to make $1,500. So you only need 2 winning trades to actually pass the account. And how you're going to get max payouts is by waiting for a perfect A plus setup as your first trade once you've actually fully passed the account, making anywhere between $3,000 to $6,000, which gets you your payout. But you still need those 4 winning days, which you trade smaller B setups in order to actually get that payout. Now, why is it actually important to know this? Well, as you can see, actually knowing the statistics behind trading determines whether you are going to pass or not. As you can see, a trader with zero edge, but actually understands how to trade prop firms, you have a 60% return on investment. And when it's a no consistency on eval, you have a 100% return on investment. Now, when you have an edge with a low risk to reward and a high win rate, it goes all the way up to 460%. Getting straight into exactly how to spot A plus setups now that you know why it's actually important to know these A plus setups and differentiate between the A plus and the B. We are going to go over the model first and then how to actually make an A plus model. First, you need to, let me redo this. It's going to be 3 steps to identifying the model. Step 1, step 2, and then step 3 is the actual entry model. Step 1 is going to be determining your higher time frame bias. You need to be always questioning on the higher time frame. Are we going external range or internal range? So does that mean are we going away from or to a PD array or away from to liquidity? As you can see in this example, you would be short because you already took out buy side liquidity and you need to have an internal range move down into a fair value gap before you can come up. And an example of that would be the move down. And then if that move has already happened, then you are going to do an internal range to external range up to buy side liquidity. Now, for your other high time frame bias on the 1 hour, 15-minute, and the 5-minute, you need to just determine whether you are in a discount or a premium. Remember, whenever you're in a premium, you want to look for shorts, as in this example. And whenever you want to long, you need to look for a discount to come down into a discount and then go long. And then also you have your session profiles. I'm going over this super quick because I've made multiple videos on this actual strategy, but not how to determine whether it's an A plus or a B setup. Now, step 2 is going to be determining your accumulation, manipulation, and distribution. So, as you can see, accumulation is going to be price generating buy side and sell side liquidity. Why is this important? Because every 4-hour candle moves exactly like the power of 3: accumulation, manipulation, and distribution. Right? The candle opens, that's an accumulation. It manipulates down, preferably into a 15-minute fair value gap, distributes up, and then closes back down. Step 2 is going to be manipulation. You want to manipulate down, taking out sell side liquidity into a 15-minute fair value gap, or a 4-hour or a 1 hour. And then you want to distribute up, looking for our entry model, confirming displacement to the upside towards previous day high or London high for a bullish example. Now, we have the actual IPD FEG entry model. Super simple. I've gone over this before, but I'm going to go over in depth a little bit more, showing you extra confluences to make sure it is an A plus setup, right? So as you can see, this is going to be our accumulation, manipulation, and distribution. This red line is going to be market open. You can see pre-market, it is going to accumulate. During market open, you're going to have your Judas swing coming down, taking out sell side liquidity, and also coming down into a 15-minute fair value gap. That is going to be step 1 between 9:30 and 10 a.m. You want to see that Judas swing. Now, between 9:50 and 10:10 is going to be the only time you're going to be entering inside of the market. You're going to want to see a market structure shift, right, in between 9:50 and 10:10 on ES and NQ, with a fair value gap going above that high. What does that look like? Just like this. Let's say this is the high of that market structure shift. You can see the candle of the fair value gap is coming through that high, showing us displacement. From there, you're going to enter. So that is your basic B setup. Now, I'm going to give you extra confluences and show you live examples of an A plus setup. What else do we need for it to be an A plus setup? We need a couple things. First of all, you are going to want, so let's say we have the whole previous day candle right here, right? This is previous day candle. You want to get the previous day consequent encroachment and make sure that the previous day consequent encroachment is around your entry. Why is this important? This is important because around previous day consequent encroachment is when the highest probability setups form. And what is an A plus setup? It is a high probability setup. So that is going to be step 1. So you can either have this where you're entering around previous day consequent encroachment, so you can target previous day high or previous day low depending on your bias, or you can be at midnight opening price. Midnight opening price is just 12 o'clock of market open. This is important because you are catching the daily power of 3, right? You have your daily candle, bam, bam. This isn't, I need to move this up. Hold up. So let's say it's like this. All right, this is how you can maximize the most points that you catch. If it's like this, the daily candle opens right here, right? You have your accumulation. It's going to manipulate down. You're under New York midnight opening price, creating this wick down, and then you can actually catch the majority of the moves of that daily candle. Now, an example for New York midnight opening price is if you are bullish, you want price to be under New York midnight opening price. If you are bearish, you want price to be above New York midnight opening price. So let's mark out what we have already. What we have already is going to be previous day consequent encroachment, and then midnight opening price. Bullish equal under, bearish equal above, right? So those are two. And that's going to be of where we want the actual profile to set up. Now, you have 3 more things that you can use to find A+ setups. The first actual confluence that you can use is going to be an SMT. There are 2 forms of SMTs that you can use. You have your smaller swing of SMTs, which is going to happen at the bottom, right? So let's say this move has already happened, right? We have our move down, but let's say this is on ES and one's on NQ. And then we have this, right? Our SMT would be at the bottom of these lows before our IPD FVG entry model where the market structure shift and the fair value gap, where NQ or ES has taken out a low, as you can see this low right here and this low right here, and then the other pair has not taken out that low. That is going to be one way that you can use an SMT divergence. The other way that you are going to use an SMT divergence is going to be on the higher time frame, preferably on the 15-minute, and you are going to look for your London and Asia low or high. The highest probability SMT, once everything else aligns, right? Once all of this aligns and your actual entry model on the power of 3 is going to be if you have a SMT where London or Asia low has been taken out by NQ, but it has not been taken out by ES, or other way around where it's been taken out by ES and not been taken out on NQ. So with that being said, those are your 2 forms of SMTs that you can use. Now, another confluence that you can use is going to be an inversion fair value gap. Now, you are not going to use this solely as an entry model. Your entry model is you have to have a market structure shift and you have to have a fair value gap. But you can throw in a inversion fair value gap. It can either be on the manipulation leg down, or it can be in one of these little moves right here. And I'll show you exactly what that looks like with a live example of how I made all that money trading today. And option number 3 is going to be a breaker block, right? Breaker block is going to be move up, move down, move up, move down, something like this. Bam, bam, bam. And your breaker block is going to be this right here. Price comes down into it and goes back out. A breaker block is a failed order block. That's the best way to think about it. So now that you have all 3, right, we're going to have SMT at recent lows or London and Asia. You're going to have inversion fair value gap. And then you are also going to have your breaker block. BB is breaker block. Okay. Now, what else can you use to find an A+ setup? The other things that you can have on an A+ setup, right, because our entry model is going to be on the 1-minute time frame, is just a higher time frame market structure shift. So a 5 or 15-minute market structure shift equals an A+ setup. So looking back into what we have for A+ setups, and I will use a new example, right? So we're going to have bam, 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 coming down, move up, move down, move up. We'll go like this. Something like this. And then we'll do market open is right here. Previous day consequent encroachment is right there. And then we also have our midnight opening price right here. Okay. What do we see already? This is a perfect A plus setup, right? We have our accumulation. Price manipulates down into a 15-minute fair value gap. Now we're inside of macro time. So 9:50 to 10:10, right? We have our SMT at the lows. We have our market structure shift right here. We have our IPD FEG entry model with a market structure shift and a fair value gap. Okay. And then we are going to have an inversion fair value gap. And then also a breaker block somewhere in here. So this is a perfect example of your A plus 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 setup using all of these confluences, right? You have your power of 3, you're below midnight opening price, you're around previous day consequent encroachment, targeting previous day high as buy side liquidity. You manipulated down into a 15-minute fair value gap. You have an SMT at the lows. You have an inversion fair value gap after your market structure shift and fair value gap, with the fair value gap going through the high, happening both on ES and NQ, and you take your absolute banger trade just like that. So now I'm going to show you the real-time setup that happened today. Going down to the 1 minute. Just so you can see it in action. This is the exact setup that I actually took today. So what do we see? Price starts to accumulate here. So we have our accumulation. We have a 15-minute fair value gap over here. And no, I'm not just drawing these out. I'm not going to switch to different time frames right now, but I have a whole trade recap on this video. So on this trade, so you can actually go in and double check this. We have our 15-minute fair value gap right here. So we have our accumulation, market opened right here, accumulation, price manipulates down into a 15-minute fair value gap. We then have, during macro time, our fair value gap with a market structure shift to the upside, just like that. What else do we have in here? We have an inverse fair value gap, IFVG, right? We have SMTs with ES at these lows. And then our targets are going to be smooth edges, which is just relative equal highs. And as you can see, we're going to enter long down here, put our stop loss there, targeting these relative equal highs, and a perfect 2.07 risk to reward with an A plus setup because we manipulated down. We have midnight opening price right here. So we're below midnight opening price, and we are around previous day consequent encroachment. So with this trade, we're going to mark out exactly what makes it an A plus setup. All right, we have the IPD FEG model within macro time. We have Judah swing into 15-minute fair value gap. We have SMT at lows, and we have an inversion fair value gap, and we are below midnight opening price. So this is exactly how you spot A plus setups, and you literally rinse, prop firms. So the real difference between passing and blowing accounts and getting six figures in payouts and max payouts monthly is not your knowledge of the model. It is your willingness to wait for those A plus setups at the correct time. So now you know the math behind how to rinse prop firms, why it's important to have a low variance win strategy and model, and exactly how to spot A plus setups, A setups, and B setups using the IPD FEG model. So if you want to learn exactly how I trade this and be mentored one on one with me, go ahead and click that link in my bio or in the description. And I guarantee that you will be I guarantee profitability and guarantee six figures in fundings, or I send you $1,000 back. Can't wait to see you guys in other videos.